All right, hey guys, it's Jordan Guess. Today is going to be a special day. We get to talk with Kendall Weihe. Kendall is a front end software engineer at Coinmetrics, uh, and he has been working there for less than a year, right, Kendall? But it's maybe 6, 7 months, something like that.
It's like 5 or 6 months. Yeah,
Okay,
something like
cool. And then, yeah, I just did a little bit of digging. Honestly, I'm going to dig a lot more into Coinmetrics website now that I did some this morning, because there's just tons of good pieces on the Insights tab. But sounds like the purpose is just to empower people to make informed financial decisions about crypto, which I just love that purpose. And it's like I feel that like as a CPA trying to help people work through the space, it's a purpose I can get behind. So, um, I mean, it's a pretty loose agenda today. We just wanted to talk through like how our conversation went last time when it was just me and you at the coffee shop. And more than anything, I am learning and you're helping to educate. And so I thought, well, why not just take the conversation and, you know, post it for other people to be a fly on the wall. So yeah, so I mean, we can jump right in. Like the first thing when I was thinking through, oh, okay, what might be good to cover today is maybe trying to just dumb down the phrase and the whole thing that has to do with crypto mining a new coin. And I don't know if you want to stick to Bitcoin or if you want to go across, because I know they might be different. But maybe we just start with Bitcoin mining. Is there a way to dumb down how a new Bitcoin is mined in a way that like an everyday person might understand?
that. Okay, so yes. So for background, I'm a computer science guy, so I I specialize in these abstractions. It's something that I can catch on easily, but I can recognize that other people have a difficult time understanding these all these abstractions. So with mining, there's two types of blockchains, generally speaking. There's a proof of work blockchain and a proof of stake blockchain. And with proof of work blockchains, those are the blockchains where you hear all this like this this FUD around like energy, like it's using too much energy. The way it works is the blockchain is secured through energy, whereas with proof of stake, the blockchain is secured um, through existing asset holders.
Okay.
So the reason why I start with, so there's proof of work and proof of stake. The term mining originates from proof of work. Proof of work is kind of the OG consensus mechanism for blockchains, and that's because Bitcoin is a proof of work blockchain. These newer blockchains are coming out are primarily proof of stake, and there's a lot more nuance to it than just that, but you can broadly think that they're all proof of stake. The reason why I say that is that with proof of stake blockchains, they're not technically miners; they're validators. So
Okay.
I wanted to start with that because you'll hear the word miner and you'll hear the word validator,
Okay.
and broadly speaking, you can think of those as the same thing. So there are entities, these miners or validators. Their role in the ecosystem is to produce new blocks on the blockchain, and so you have this blockchain. It's a giant chain of blocks, right? And it's a giant ledger, and it says, these addresses have these amounts, and transactions sent from this address to a different address. So you have this giant chain, which is a ledger, and then it's arbitrary to whatever chain it is, but there's a time interval where new blocks are produced. So these miners and validators are the entities that are producing the new blocks. And the way it works is you have a network of users. So you have a bunch of users, and say they want to submit a transaction to a blockchain. So say I want to send you, 1 ETH. Then the way that works is I broadcast that transaction to the network and say, hey, network, I want to include this into the ledger. Mm-hmm. And then the block producers, miners or validators, will receive my request, and then based on it's a competition. So one of the miners will win the competition, and then they have the rights to accept my transaction and then write it into the blockchain.
Okay. So yeah, and this is one, I think this is one, if we stick to Bitcoin for just a moment, like, I think this was something that just clicked for me within the past couple weeks, where miners play a role in creating new Bitcoins, but they also play a role in, if I wanted to send you some amount of Bitcoin, they also play a role in that process as well, right?
Correct. So there's 3 things that miners do. They secure the network. They're the security mechanism. You're paying them for security. Mm-hmm. They produce new blocks, or rather, that is to say, they write transactions to the ledger.
Okay.
So they, I'm going to repeat that. They secure the network. You're paying them for security, and then you're also paying them to write your transactions into the ledger. The third thing that they do is it's not actually them. It's not actually in their discretion. It's not under their locus of control, but they are awarded new issuance based off of new blocks. So, and this is arbitrary from blockchain to blockchain, but okay, let's stick to Bitcoin. Yeah. So with Bitcoin, you have a monetary policy that is fixed. Monetary policy meaning how are new units issued into the system. It's actually a little funny. I mean, on a very technical level, Bitcoin is technically inflationary because new units are still being issued, and so every block, I think the block reward right now is it 6.25 Bitcoin. And so if you're a miner and you win you win the competitive game among other miners to produce a new block, then you have the rights to, in that block that you're producing, you can basically write 6.25 new Bitcoins to myself, because you're the one that's literally writing the ledger. Yeah.
Okay. And I was digging into this a little bit. It sounds like the process of the competition that you mentioned is similar to, hey, Kendall, I'm thinking of a number between 1 and 1,000, but it's 26 characters, and some letters correspond to numbers, or the other way around, maybe. Like, is it and they're trying to pretty much, it's a guessing game, right? But it's really supercomputers that are just trying to compile as many guesses until they get their one right, and they're competing with all other kinds of miners that are doing the same thing. Is that basically, I know that's probably not a great explanation, but is that the 26 character thing is right? That's
correct. So let's just talk about Bitcoin, because proof of stake networks have a different competitive game, basically.
Okay.
But you're correct. The way that proof of work blockchains operate is you're essentially you're tokenizing, you're requiring energy, because energy has a cost. Energy has a required cost. There is no such thing as like free energy, right? That's like fundamental to physics.
Yeah.
Energy is really the most fundamental layer of civilization.
Yeah.
So the game requires you to expend energy in order to be competitive. And there's a nuance here that I want to try to convey, that leads to maximum security in the network, because so let's say that I were to win a block as a miner. People, so you're right. So the way the game works is that you have this, 1 through 1,000, you're searching for a needle in a haystack.
Mm-hmm.
So you're requiring energy to brute force, to basically guess and check. Mm-hmm. And then finally I find one. Then I can publish that proof to the network, which basically says I have the current difficulty level. That's called the difficulty adjustment, which is how wide is that range. So that range could be from 1 to 100, or it could be from 1 to 1,000, or it could be 1 to a million. And so I publish the current difficulty level, and then I publish the basically the number that I find. And then that's the proof that basically, X amount of energy was expended in order to find that block. Does that make sense?
Yeah, I think that makes sense. I mean, I think just dumbing it down, it's a guessing game. And it's not necessarily actual humans who are writing out numbers and submitting it. It's more randomized computer algorithms that are kind of doing this, and then these are large operations. Like, my understanding is that you as an individual, it's almost 0% chance that if you went out and tried to go, even if you spent a little bit of money on one, is it called ASICs miner,
Mm-hmm.
for a Bitcoin miner, there's almost no chance that you just having one machine, or it's just a very low chance, I guess, because you're competing with huge farms of machines, right? That's like warehouses full of these things. Is that right?
But what's interesting actually is what's interesting is that an individual can actually still be profitable today. And where the issue is actually in the middle ground. So if you're just like a small operation, like, a handful of ASICs, you can be profitable. But if you're like anywhere between that up to like these giant farms that you're talking about, then like you're going to have a difficult time being profitable. And the reason, the way that works is like, which is actually, as a side note, like my analysis of that would be like, that's very good, because you don't want that competition to escape the everyday individual. Like you still want the everyday individual to have the ability to be competitive. You could think of it like entrepreneurship, right? So like, it's relatively easy to like start a business, and like, maybe you get like early, it's easy to find like, at least maybe a little bit of revenue. And then it's like, but then like, man, going from like a little bit of revenue to like, a public company, that's a huge journey. But then like, also once you're a public company, you're pretty much solidified, like you're ossified. Mm-hmm. So it's very similar to that. And the way it works is like they're mining pools. And so like, it's not like basically there's networks of individuals that can group all of their hardware together. Yeah.
Okay. Yeah. I mean, well, and that's another thing that, sparked my interest, is as I'm meeting some more people on Twitter, and they're doing these mining, I think they're considered mining pools, where pretty much 7 or 8 people will get together and say, let's buy our first mining rig, which, for people who don't know, it's like a physical kind of like CPU looking thing, right? It's yeah. And you plug it in, and then it starts mining, and there's ones for every coin out there, I'm pretty sure. But anyways, I keep running into people these are businesses. I mean, these are people who are, like Kendall said, expending energy. That's one of their overhead costs. The original cost of whatever the machines that they're buying, that's a cost. But outside of that, as long as what you're getting rewarded is, ramping up to cover those costs, then it can be profitable.
So I want to say one more thing about this. So proof of work mining is like, it's a little difficult to understand, and like it's you could teach a college course on it. You could teach like an upper graduate course on it, frankly. But it can be simple enough to where everybody can understand it. The thing is like the thing that I really don't think a lot of people have really picked up on is that like this is the most fundamental piece to this entire thing. Like the ability to have digitized energy that is location independent. Like that's the innovation. I would go as far as to say that like there's like a Kardashev scale. Kardashev scale is like 1 through, I think it's 1 through 5, which is like, you know, it measures your like the level of your civilization, like how advanced civilization is. And you know, type 1 is like your multiplanetary. It's like, I don't know, I forget, it's like type 3 is like you basically inhabit the entire solar system, blah 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 blah. Like we are not even a type 1 civilization yet. But it is my opinion that in order to like a foundational component to getting to a type 1 civilization is to have basically digitized energy. That's a requirement. Yeah, but
no, that's cool. Okay. So and like, okay, so the other thing that I think this clicked for me, and this was important. So definitely if I wanted to send Bitcoin to you, the miners are involved in that process. They're involved in the number of new Bitcoins. And another note is just really quick for people is you'll hear that block reward every 4 years, it gets cut in half. And so it used to be that you got like 12 Bitcoin 4 years ago every time you solved the puzzle. Now you're only getting like that 6.25, whatever it is. So that's another piece. I mean, that's a whole other conversation, but the supply gets over time, the rate at which I guess the supply is coming in shrinks. Is that a good way to say it, Kendall?
Yeah, for Bitcoin. So each chain has their own arbitrary monetary policy. So each chain has and it's a free market, right? So it's a market of chains that are all defining their own monetary policy. Again, monetary policy meaning how are you controlling the issuance of the units in the system? So with Bitcoin has had the same monetary policy from day zero, which is 21 million coins eventually, which will be mined by the year of 2144 or something, so 100 years out. And roughly every 4 years, the issuance gets cut in half. So that's what's referred to as the halving. With Ethereum, if you look at the monetary policy of Ethereum, it hasn't been fixed, so it's been all over the place. Most recently, EIP 1559, if you've ever heard that, basically it's an update to the protocol. It actually made it deflationary, so now the issuance is negative for Ethereum, and we could talk about that too. But yeah,
and I guess like the basic problem with fiat currency and what a lot of Bitcoiners believe with other cryptos, just so everyone knows out there, is like the cool thing about Bitcoin is it can't be changed. Whereas these other coins, you'll hear the word protocol, I think, thrown around, but it's really just like the rules that the coin has to play by. They can be changed. And Ethereum is a good example of a really mainstream coin that, you know, it's more or less a company. It's less decentralized. It's a lot less decentralized than Bitcoin. Wouldn't you say, Kendall?
You know, what's interesting about Ethereum is actually, people hate on this a little too much, in my opinion. Ethereum is really quite decentralized.
Okay.
Now it's not on the level of Bitcoin. It all comes down to there are two major user demands in this space. So as the users the user is sovereign. Like the user gets to define what ends up happening over the long term. Mm-hmm. And there are two major user demands. There is decentralization, and there is basically like scalability, or like how like I should be able to send you money for basically zero cost at any scale, and it should be instant.
Yeah.
So those are the two demands, right? So like decentralization, and it depends. Like each chain will prioritize one over the other, right? And it's a give and take. Like you can't if you it's not that it's hard. You like right off the bat. Let me say it this way: in the early stages of this asset class, you kind of have to choose one or the other. Like you have to choose decentralization, or you have to choose scalability.
Yeah.
And so, like Bitcoin and Ethereum have both chosen decentralization. Bitcoin absolutely maximized that. Like that's the number one thing Bitcoin went for. Is like we want censorship resistant money that is everybody that is totally decentralized. Ethereum also is like that, but then on the other hand, you get to these other blockchains such as like Solana, Avalanche, Tron. They went the other way, so they prioritized basically throughput. They prioritized transaction volume, and in doing so, they are less decentralized. Like it's actually very difficult to run any of those nodes if you're not any of those blockchains if you're not an expert. But yeah, I think Ethereum gets a little bit of a bad rap. I think Ethereum is relatively decentralized. The problem that I think that Ethereum is going to run into, this is very high level, is that Ethereum has kind of always tried to ride the fence. Like it's always tried to do both. It's tried to be both decentralized and have throughput, but it's kind of like in trying to do everything, you may end up with nothing. That's my concern.
Yeah. That leads me into another part of this conversation. We can probably move on to this. Is the scalability question? And I know that YouTube video that you sent to me kind of sparked this a little bit with some of these other coins. They're called layer ones for people who aren't familiar. But just a brief introduction to what he was just talking about, I think, is the founder of Ethereum, and I can never pronounce his name, but he kind of maybe brought up this scalability trilemma where you can have security, you can have decentralization, and scalability. And his whole thing was like, you can have two of those things, but it's hard to have all three of those things. And I think that was going to just what you were just saying. So, So the whole thing we're trying to get at is, or at least with scalability, is increasing the number of transactions per second. And just for an example, Visa does 1,700 transactions per second, and then go to Bitcoin, they only do 5 transactions per second. That was a little brief research I did. Ethereum does 17 per second, and Solana 65,000 per second. So that kind of goes to your point earlier. So I guess, that conversation was interesting. It definitely brought up, I'm at the tail end of it now where they're kind of talking about like, is the blockchain even going to make it? Or are they just going to, have coins for everything? Like the conversation was kind of interesting to me, but
okay. Can I jump in? I want to touch on that actually.
Yeah. Go
so, okay. I'm a pretty hardcore software engineer. Like I really value the technicals of the solutions. And I've always had a problem with this space, frankly, that, a blockchain is not actually the correct solution for most of these use cases. Like, to be frank, long term, the only thing that I'm sure of a blockchain is useful for is monetary phenomenons, which is to say, an actual money, that's Bitcoin, right? Using a blockchain as a data structure for smart contracting. Look, there's a ton of marketing towards it, and I can appreciate that. And I'm not saying that it's going to go away anytime soon. The problem that I have with it is that ultimately, all mature markets become commoditized, and commoditized basically means, like, in this context, it reaches the most efficient solution. So as an engineer, I can identify what the most efficient solution. And what I mean by that is like the least, your margins should basically be thin, right?
Mm-hmm.
And if a new solution comes along and it provides the same value to the end user, but it's a lot cheaper, then clearly the user is going to go towards the cheaper option. They're not going to, I suppose people spend some of their money on moral things, like, people will donate to charity, things like that. But when it comes to utility spending, which is or any sort of, a lot of any type of consumption type spending, then they just go with the cheapest one, right?
Yeah.
So yeah, I've always, and a blockchain is not the most efficient data structure for smart contracting. I'm sorry to say, but it's just not. So it's funny, these, there's like this Web 2, Web 3. Web 2 is like, like the current web kind of thing, where you have like Facebook, Google, you have these tech giants. Web 3, this is this idealized thing where it's, you basically like, you take those tech giants and sort of decentralize them. What's funny is if you ask these Web 2 people, which admittedly I come from Web 2 background, they're like, what? Like, why do we even need a blockchain? Like, we can just pass tokens around. Like, a token doesn't have to be secured on a blockchain. Yeah.
And you're thinking even in like use cases that people have put out there, like with smart contract, to say, I think I've heard the example of, because Web 2 version is Uber, right? I need to communicate with Uber, and then Uber goes and finds me a driver. That person comes pick me up. The Web 3 version would be, I interact peer-to-peer direct with a driver through a smart contract or through the blockchain, and then that person comes and picks me up, and we have a transaction just between the two of us. But you're saying that might not be, the blockchain might not be the best data-driven solution? Okay.
Correct. The user experience that you're describing is the correct user experience, which is to say, cut out the middleman. Mm-hmm. And this is somewhat like philosophical. Like, I'm not saying this will happen anytime soon, but I tend to like to talk about things that I think are like 20, 30 years out.
Yeah.
Yeah, like the blockchain is not the correct solution architecture for that problem. What really matters is just a network. Like you need to have a network of individuals that are all communicating and that reach consensus. Yeah.
Interesting. Okay, but you think right now, and I definitely see this with like the marketing comment that you made. There's just tons of marketing. There's tons of money that's being made, even by Web 2 versions of, I would say, some exchanges, like even Binance, it seems like, is the best example right now of, they make themselves out to be this crypto decentralized thing. But based on that conversation I was listening to with those guys, and maybe they don't even do that, but they're a centralized network and database, right?
Yeah, I mean the Binance, I think Binance chain, you can't even run a node. Like it's 100% centralized. Only Binance runs nodes. So it's like, well, what are we doing here? Like it's like you can leverage the marketing to acquire customers, and I can appreciate that. So like these exchanges are a really good use case to understand sort of the narrative I'm trying to develop or to explain here. Mm-hmm. So so I've been reading up on so Jack Dorsey owns a company called Square. It's actually now called Block, right? Mm-hmm. He's a CEO and the chairman of the board, which is a financial company. They own Cash App as well as a lot of other products. Block has a new division called TBDEX, which is, I think it stands for to be decentralized exchange.
Okay.
So the problem with exchanges, any type of exchange, is that, like, okay, so just for background, what an exchange actually is an exchange is actually just operating an order book. And what an order book is you're matching buyers and sellers. And so you have a whole big wall of buyers on one side, and you have a big wall of sellers on another side. And you're this middleman, which, this seller is willing to sell for $100. This buyer is willing to buy for $100, and boom, I'm going to match these two, and then we're in exchange, and I'll take a little bit of fee on top.
Mm-hmm.
That's how an exchange works. It's just an order book that's matching bids and asks. You can see how that could be decentralized. Like, why is there this middleman? Why is there this middleman that's needed to match a buyer and a seller? Like, for example, think of Craigslist, right, or Facebook Marketplace. Like, these are digital networks, let's call them, that I can log on to, and I can interact directly with a buyer or seller, and like, they're not even taking any money, right? So you can see how that's like a commoditized version of a decentralized exchange.
Yeah.
And really, if like, so this TBDEX that Jack and the Block people are working on is very interesting, because what it really amounts to, again, there's no blockchain, there's not even a token, they're not even so then it's like, what are they even building? Like, if it's not a blockchain and it's not a token, and what even is the thing? What they are building is just a communication, a messaging protocol, which is designed to be optimized such that buyers and sellers can be matched without any sort of intermediary. And so, like, let's say I'm trying to sell something to a buyer without any sort of intermediary. There are risks associated with that, because it's like, well, maybe I send them the money, but then they never send me the product, or vice versa, or like, a number of things could happen. So, well, what you can do though is you can basically apply digital technology to limit those risks. You can never have no risk. You're always going to have some amount of risk, but you can use digital technology to limit them. And all that needs to occur is a messaging protocol. Like, you just need to be able to communicate back and forth that certain events have occurred. And there is a time and place for a third party as well. I'm not going to rule that out. But okay, that's my riff on.
No, that's interesting. So,
exchanges, yeah.
But do you still run into the risk of that Bitcoin talks about solving, of I'm communicating with, like, I'm a buyer and I'm communicating with two different sellers, and I'm saying I have one Bitcoin total, but I'm saying to this one and this one over here, I'll give you a Bitcoin for this, and is this the blockchain?
So this is a perfect question. So this is where Bitcoiners get it a little wrong, actually.
Okay.
Bitcoiners are very obsessed with anonymity, right? So they want to be totally anonymous.
Yeah.
I shouldn't broadly say Bitcoiners. It's anybody. Okay, let me back up.
Yeah, there's a lot of people who have that held as a very high value right now.
Yeah, so anonymity frankly does not work in social settings. Like, it's I'm not going to say it never works. There are situations where anonymity is a good thing. The problem with anonymity is it leads to things like Twitter bots. People can DDoS people. Like, if you can have a totally anonymous system, then there is no resistance from me just spinning up a billion anonymous accounts and then just totally storming everything you're doing and screwing everything up.
Yeah.
So anonymity is actually a dangerous thing in social settings. Again, I'm not totally, but most of the time. Now, pseudonymity, okay, now this is where it gets interesting. Satoshi was pseudonymous, okay? He wasn't anonymous. Anonymous means that nobody knows who you are, and also like you basically have no credit, no social credit ranking, or credit score, I should say.
Yeah.
Like you are basically just like this like entity that's new, and like nobody knows who you are, and then it's like what's your claim? What can you bring to the table?
Yeah.
Pseudonymity is like people don't know who you are, but you have a credit score. Like you have this like this basket of work, which you can say, and you can prove I did all this stuff. Now that's useful, okay? Because if a person has a credit score, that's all I really care about, because if it's just the same way that like Amazon ranking or reviews work, right? So like I feel safe buying one Amazon product versus another because this first one has like, really good reviews. Now Amazon tampers the reviews, but this is just an example to prove a point. So anonymity, problematic a lot of the time. Pseudonymity is great, and that's what we're going for, because you can build credit scores, and credit scores are required in order to limit risk, to build more trustless systems.
Yeah, which I think a lot of people hear that word and they can get a little triggered. But I mean, as if we're moving to something like dystopian, but we already have to do that in the regular world in all kinds of things,
Oh yeah, I mean, like I'll go to the store and like I don't know who like put this banana in on the shelf. Like they could have had COVID. Like I don't know anything about it, but like I trust the institute. I trust the credit worthiness of the store that I'm going to. Right.
And that is an issue going into the future, is like, okay, if we are going to do peer-to-peer, if I send you crypto right now, there's no institution that I can go back to and say, I didn't mean to do that, or that person pissed me off and I want a refund. My understanding at least is there's no refunds. We're living in you have to be a much more responsible human being if we are going to go down this path.
Yeah, because there's still too much risk in the system, to be frank. Like I wouldn't be spending large amounts I wouldn't like buy a house with Bitcoin unless from a pseudonymous person across the globe that I know nothing about. Like no way am I gonna I'm never gonna get my Bitcoin back, and then I'll also never get a house.
Yeah.
So like the way that those things are remediated is through like social constructs, right? So like if you just think about the way the current mortgage system works, like it's there's a lot of room for improvement and efficiency gains, absolutely, but like the general social constructs are all optimal, frankly. Like you should have some sort of escrow, you should have some sort of legal binding, because in the event that something does go wrong, then there should be recourse. So, and all those things can be solved, right? And they will.
Yeah.
But yeah, Bitcoin is not reversible, so don't send your Bitcoin if unless you absolutely.
Yeah, the people who are like, send me 1 Bitcoin, I'll send you 2 Bitcoin. Those are never true. No. But it will be interesting to live in a world where, say you have the money I need for a house, and it's a very small, what I need is a very small percentage of maybe your net worth, and you say, and maybe we've never met each other, and we find each other on some kind of network where you say, I will loan you, pretty much you are the mortgage company and I am the person taking out the mortgage, and we can go. Do you see a future where that is, and I know that's already happening in some ways, right? Where the people
absolutely
are out.
Absolutely. Look, okay, this is what it all comes down to. It comes down to 2 things. First off is energy. It comes down to the proof of work mining, which you talked about. And then the other thing is internet money. It's money that can be sent at the speed of light, for no cost. Now, that is a very if you have both of those things, your society is going through the roof. Like you're going to go through a massive revolution, probably like you've never seen before. Because when you have this money that can be sent at the speed of light for no cost, you can hire a bunch of programmers like me to build all these automated systems. And so, like this is, man, this is so like I just get so hopeful about the future whenever I think about these things, because like for your example is perfect. Lending is a massive industry, and right now lending requires a lot of overhead. There are a lot of middlemen. You got to check your financial credit score, which is managed by TransUnion, and then who are they? And then they got hacked, and then there's a bank, and then I got to go through. I got to get a lien. I got to do title insurance. Like, there's a person every step of the way, and there's a person expecting to collect a sizable fee.
Yep.
Now, literally, all that stuff can be automated, and that's happening today. Yeah. So like you can go on Aave. Aave is a protocol, is a lending protocol. I think it primarily operates. Well, I think it's multi-chain. I think it's on various chains. And the way it works is like, it doesn't matter who I am. It doesn't matter what my credit score is. It doesn't matter where I am. If I can prove that I have sufficient collateral to cover a loan, then I can get a loan instantly. And look, that's incredibly risky, and I don't recommend doing these types of things. But it's a proof of concept to show that, like, frankly, I should be able to buy a house in a day. I should be able to see, like, I like that house, I'm buying that, and now it's mine. The same way you go through a checkout line at Target, same thing should happen. Well, I guess you do have like appraisals and stuff, but you could technically digitize that too.
Right. Because if you had a whole network or where you could see very easily, hey, the last 2 houses down was sold for this amount.
Yeah.
And then, okay, pull comps. You don't need a real estate agent anymore to pull all these comps to know roughly. Because, I mean, let's be honest. Hopefully I'm not offending any appraisers out there, but I think it's like whatever the purchase price is, they're going to get pretty close to that. I think they know that, that going into their appraisal, they pull some comps, and it's pretty much that. I mean, there's not a ton that goes into it. So you could pretty easily, I'm sure, automate that whole process to say, this is the value of the home based off of these metrics, and, then go from there.
Like this,
I'm just going to pay for it in cash.
Yeah. And this is all very futuristic, what we're talking about, but it's good to know, like this is, in my opinion, when I hear a conversation like this is what I truly consider decentralized finance. Like, what decentralized finance means to me is like I should be able to buy a house in a day. Yeah.
With no middlemen, and you got to think the cost of the home overall will be a lot less if you cut out all these middlemen and have more or less a one-time fee for someone to build the automation.
You can see how this internet of money, this like money that you can send at the speed of light for zero cost, will basically commoditize almost everything. Like all of the margins that exist will be commoditized. They'll become razor thin. Now, that's like pretty far out, and then it's like there's so many socio-political things that have to. We're really just talking technicals here, but it's technically possible, right? And like that's extremely promising.
But do you foresee a future where these centralized authorities and these middlemen, they push back very hard? Because what does a future look like if banks can't lend out anymore, and instead everyone else is their own bank? Do you think that, Bank of America, Chase, do you think there's almost like a crazy, I don't want to call it war, but there's just like conflict and just trying to battle out these ideas? Do you foresee them giving a lot of pushback to this new space and almost trying to hinder it? Or do you think that's even already happening in some ways?
Well, I think there's multiple questions there. Like, I think that any business that is founded on where the moat, the competitive moat is basically cartelish. What I mean by that is like you have a cartel of businesses that only offer these services and they can rake in money because they basically work together.
Yeah.
Any business where that exists, like that won't last for super long because it's all really a race to the bottom. Like there's clear division of labor that needs to exist in advanced civilization. I'm a computer guy. I don't know how to build a house. I don't know how to like build a car, and so I have to pay people to do that. And I don't expect that to get that at cost. I expect to pay some sort of premium because there has to be an incentive there for the thing to exist. But just broadly, these margins come down. With banks specifically, it's interesting with banks. There's so much I can say about banks. I mean, I'm not really a professional in this area, but I'll say two things. Like, on one hand, the banks are going to be gutted pretty heavily over the coming decades, just because banks make a lot of their money through like secondary markets, which is to say that like they will lend you money, but then they'll sell that for a bond, and then the bond gets sold 100 times until it ends up at the Fed, basically.
Yeah.
And then and they also participate in money markets. Like, the way that banks make money is not typically off of user fees, like custodial fees.
Right.
A
lot of it's lending to other banks, right?
Yeah.
Margins and all that. Yeah.
Yeah. So, like they're in for a change. I'll say that. And on the other hand, like the social construct that is a bank will not go away. Like, that is something that is optimal for a large portion of society.
Yeah.
Like, a guy like me, I'm a tech guy, so like I can take custody of my Bitcoin with like no problem, and like I feel totally secure. I feel more secure if I have it than if somebody else has it.
Yeah.
You know, if you were to ask me what my sisters are not capable enough to custody their own Bitcoin. They're going to want a third party custodian, and that's okay. Like, as long as the third party custodians are like regulated, or have like, and I don't mean regulated necessarily by governments, but regulated by some forcing function that incentivizes them to behave appropriately, then that's a good thing. Like, that's just division of labor.
Right.
So yeah.
Yeah, I think that's like a huge thing that I'm going to do my best this year to accomplish. It's just like bringing more people into the space. Specifically, probably for me, targeting people like 40 and up. Just trying to explain the risk, and maybe at the end of the day, they look at it and I assume this will be a lot of them. It's not for me, but at least trying to like train myself to explain all of this in like a dumbed down, easy to understand way, which obviously I would say is the biggest hurdle for the space right now.
Absolutely.
There's so much. Like, I literally met, my wife and I were at a bar last night. We met a lady whose crypto came up, because it always does. And I just had to look at her because we were about to leave. And I was like, it's probably too long of a conversation. I've devoted, even in the past just year, I've devoted probably 60 hours of like really focused education, and really just on Bitcoin. I mean, I've just now started to spread my wings a little bit out. So I think stuff like this, to bring it all back, I think stuff like this, conversations like this that are shared, can be helpful, even if only a handful of people take the time to watch it. But yeah, I really appreciate you getting on with me and talking. I know you've got a hard stop here, so I want to be respectful of your time, but do you have any other closing thoughts?
No, I mean, I love what you're doing. We need an army of people like us, you know?
Yeah.
It's like there are clear thought leaders in the space that like I follow, and it's one of the reasons why I'm very knowledgeable of all the industry at large. But it's like if you really want to scale this thing, you need an army of like of people from all different backgrounds that are, like you said, just talking about it like at the bar type of thing.
Mm-hmm.
But it has to be knowledgeable as well, right?
Right.
So yeah, I love what you're doing.
Cool. Well, hopefully we'll maybe do it again. Do you want to just plan on doing it every week, every couple weeks? What sounds good to you?
Could we do like let's start with every 2 weeks, maybe?
That sounds good.
Yeah. And yeah, there's lots to explore. We went sort of philosophical in the latter half and technical in the first half. Like, I think those are both relevant in a lot of ways. So yeah, whatever you want. You lead, I'll follow.
That sounds good. And then you teach, I'll listen.
Okay. Yeah.
Cool. All right, man. Well, I appreciate it. I hope you have a great rest of your day.
Thanks.
All right. See ya.
Yeah.